Friday, Bloomberg reported that the White House might be on board with making it harder for Chinese companies to access American capital markets. But yesterday, Peter Navarro, arguably President Trump's most hawkish trade advisor, came on Squawk Box, walked it back, calling the story fake news. I got to tell you, that's actually too bad. We should make it harder for Chinese companies to raise money here in the United States. And I'm not even talking about this in the context of the trade war. This is purely about protecting investors from garbage merchandise. What we need is a moratorium on Chinese IPOs. As I've been telling you for ages, companies from China keep coming public here in the United States. And for the most part, this deluge of deals has been a nightmare for anyone who's participated in them.
The House of Pain.
There are a few winners, but for the most part, Chinese IPOs have been incredibly toxic to your wealth.
Sell, 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 sell.
We've had 31 of these deals last year and 14 more in 2019. Do you know that almost all of them are underwater? On average, these stocks have fallen 32% from where their IPOs priced. If you go by where they closed on their first day of trading, they're down 37%. In a market that's already overwhelmed with low-quality initial public offerings, the last thing we need is more questionable securities from China, which has much weaker regulations surrounding all this stuff than we do. Chinese companies should comply with our disclosure rules. It makes a ton of sense. If you want to list your stocks on a U.S. exchange, you should have to follow U.S. securities law. In fact, it's total lunacy that this isn't already the status quo. What happens when you let Chinese companies take advantage of our stock market without subjecting them to the same disclosure requirements as U.S. companies? I'll tell you what happens. Investors get burned. That's what. So tonight, I want to lay out the quantitative case for imposing some kind of limitations on new U.S. listings for companies based in the People's Republic of China. When you look at all 45 Chinese names that came public here in 2018 and the first 9 months of 2019, their underperformance is staggering. Like I told you before, these Chinese IPOs are down an average of 32% from where they came public. 32%. And that's not just a few bad apples spoiling the whole bunch. The median Chinese IPO was down more than 37%. Of all 45 stocks, only 6 are up from their closing price on the first day of trading. 6! In fact, there's a whole pattern here. The median Chinese IPO peaked 22 calendar days after it came public. A third of them peaked on or either their first or second day of trading. Roughly two-thirds have been cut in half from their post-IPO highs. In other words, typically Chinese IPOs may start strong and roar higher in the first few weeks, but then they quickly get peaked, and then they tend to get eviscerated. When you look specifically at the class of 2018, there were 31 deals. Only 3 of those stocks are now above their IPO price, and this has been a good market. Only 3. Now, those 3 winners are up anywhere from 20% to 95%, and they're often the ones that are thrown at me on Twitter by a bunch of chowderhead sunshine clowns as reasons to be excited about the Chinese deals. But that doesn't come close to offsetting the 28 losers, some of which are down 80 or 90% from where they came public. Thanks, PRC. As for the 14 Chinese deals from the class of 2019, only 4 are above their IPO price, and who knows how long those 4 will continue to hold up. Those are terrible odds. I would sell them all. While this year's crop is only down 18% on average, remember the S&P's up 17%. This is only down 18%. The median is much worse, down 32%. More than half of these stocks peak within a week of coming public. I think the 2018 vintage is doing worse simply because those newer names haven't had as much chance yet to disappoint you. What more can I say? The overall track record of these deals is abysmal. There are some distinctions, though. The larger Chinese companies tend to perform better. But even with the winners, most of their gains came on the first day. So I would sell any of these and invest in companies where the disclosure is stronger. Because as Justice Louis D. Brandeis famously pointed out, sunlight is the best disinfectant. How about a more in-depth example? Why don't we consider the case of one you've asked about many times? Let's consider the case of NIO, N-I-O, which came public a little over a year ago. Normally, I wouldn't talk about a $1.32 stock. That's right, it's $1.32. But NIO has a $1.38 billion market capitalization, and more than 26 million shares change hands every day. Plus, 2 weeks ago, NIO was trading at $3. It's only below our usual requirements because it's fallen so fast, so far. That's why it's the perfect example. NIO makes luxury electric cars. Sounds compelling. So going in the deal, it was hailed widely Chinese Tesla. We've seen the same story so many times. The Chinese this, the Chinese that. NIO's IPO priced at $6 and change. Then it shoots to $13.80 2 days later because of all the hype. To this day, that remains the stock's all-time high. NIO quickly gave up the gains, trading back to the mid-single digits. Then in February, 60 Minutes ran a segment on China's drive to dominate the electric car industry, where they called NIO the Chinese Tesla. So, of course, the stock caught fire and it surged back to 10 and change. Once again, though, those gains didn't last. A few weeks later, it was back at 5. And it's been all downhill since then, stock getting annihilated over the past few weeks. What went wrong? First, about a month after the 60 Minutes piece, China announced that it was scaling back its electric vehicle subsidies. Very bad news for NIO. Then in June, they had to recall nearly 5,000 vehicles after a number of them caught fire. Suboptimal. Finally, last week, the company reported a much larger than expected loss. Now you have all sorts of analysts speculating that NIO could run out of cash. When, a matter of years? Matter of months? How about weeks? Meanwhile, the actual Tesla has built a factory in Shanghai. It's getting ready to take China by storm. This is a textbook example of how people get burned by Chinese IPOs. The bull thesis for NIO could be boiled down to a single sentence. Chinese Tesla is a great elevator pitch, but there was no underlying rigor. Then the stock gets crushed by a series of unforeseen events, a rule change from China's government, a big product recall, shockingly negative earnings numbers. I bring this up not to give NIO a hard time, but because NIO is stereotypical. The bottom line. The last thing we need right now are more low-quality Chinese IPOs. I would love for our government to block these deals, regardless of what happens with the trade talks, because they are hazardous to your wealth. But even if these Chinese IPOs keep coming, you can avoid getting burned with this one simple trick. Just say no. Stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.